Let's get a very special guest now. Esty is now joining us on the phone line, Head of Global Market Strategy at Natixis. Esty, thanks so much for taking out time for us. Could you just tell us what are markets trying to price in? Is it looking worse than 2008? What's really happening?
It's looking worse than 2008. I think it's looking different than 2008 because you really have activity at a complete standstill. And what the market is trying to decide is Q2 going to be the worst, and then we have a recovery in the second part of the year, or is this going to drag on because we're going to see waves of defaults, of bankruptcies, and as much as governments and central bankers are doing, it might not be enough. So that's what the market's trying to price in.
When we talk about, the price damage that has happened, you think it's the price damage that will also create problem going ahead because asset prices, the sentiments that's coming in, companies will not be able to raise funds. What really happens in such a situation?
At the moment, it's about short-term funding and the ability of businesses to make payroll, to make rent, to make short-term, any operational commitments. That's leading to a lot of concerns for specific industries, but businesses as a whole, because you're seeing airlines, you're seeing restaurants, you're seeing entertainment, everything is stopped. The second question is, how much can they borrow? Is a sort of bridge loan over a few months going to be enough? Or is this going to really be a lot worse? So that's one of the questions. Of course, the negative news on prices is also raising questions about feeding into recession. But at the moment, I think it's a lot more about consumptions and really fears about defaults and bankruptcies, and therefore skyrocketing unemployment, which can then feed into a recession itself.
Hi, Esty. This is Mubina as well joining in. What I want to understand is that obviously with the sort of decline we are witnessing across all asset classes, and naturally the fact that there's obviously going to be a further slowdown in economic growth just when we were seeing some signs of recovery, central banks, governments are coming in, pushing that fiscal and monetary stimulus. Do you think that is something that would give some support to equity markets? Because clearly it's not working at this point of time. Or do you think it's only and purely going to be any sort of cure that may be found, or any stability in the coronavirus cases, and only that will trigger any recovery in equity markets?
I think we can have a bounce. I think we can have short-term stabilization on the stimulus. I think the fact that governments are really doing so much is going to help. But until we see a peak in cases, we probably won't see an actual recovery. For now, we just don't know how long the slowdown or the stop to activity is going to last. So if it's a month or two just to sort of ease this epidemic and get to a peak in cases, then we can gradually pick up in the second half of the year. If this peak in cases does not arrive, that means the standstill has to last a lot longer. The recovery will be even slower, and that's what's really worrying markets at the moment. So stimulus is fantastic and was absolutely needed to halt sort of the massacre in markets that we've seen in the last few weeks. But if you think about it from a historical perspective, given the question marks that remain, even though it was the biggest, fastest drawdown in history, or at least since 2009, 2 or 3 weeks of correction probably is not enough. We can't have solved, we don't have the answer. So stimulus, absolutely necessary. Governments finally understanding the urgency of this and pulling out, the 2008 playbook. But I think you're going to need to see a peak in cases to show that the containment measures are working in Europe and the US like they did in Asia for markets to really be able to calm down and recover.
Okay, so stimulus measures are absolutely needed, and I think that's what the governments as well across the globe have done. That 2008 playbooks as well have been drawn out by a lot of the governments. Now, it's Esty, where can we find the safe havens amidst this market? Where can the money find refuge? Because, your usual safe and traditional safe havens like gold, silver, palladium, all of them as well have seen, quite a fall. Gold went below $1,500 per ounce just yesterday, and one would ordinarily expect this one to stay resilient and how, but it's a coordinated sell-off across all asset classes. So where do you see refuge lying?
At the moment, it looks mostly like the U.S. or the U.S. dollar, potentially U.S. treasuries, even though yields have drifted up. We did see a bit too much of a sell-off, and we saw some freezing in the treasury market, which has led to yields rising again. But I think yields there are going to stabilize, and people will go to the dollar. The truth is, cash is king again. It's what we've been doing in our portfolios, trying to raise the cash. And for two different reasons. One, it provides the sort of ultimate buffer. But second, because we still think, and we're still in the scenario where the second half could see a recovery, we want to have dry powder available as well. But I think what we're seeing across everything is sort of indiscriminate selling. Liquidity is needed, so people are selling whatever they can, and that includes gold at the moment. They need to meet obligations. People might need to meet margin calls. People just need to have that cash available. So for now, still a little bit in safe havens and some cash waiting, hopefully for stabilization to be able to redeploy it in the next couple of months.
Thanks so much for taking out time for us and telling us what really to expect, how to see what's happening into global markets.